If you're buying shares of stock, you aren't using your capital in the most efficient way. When you buy shares, you're paying full price, but instead you can get a discount. So I'm going to be showing you how you can do that. And that's going to be with LEAP options. With LEAP options, you can get the same long-term exposure without paying full price. It's the same ride, the same trend, the same upside, just way cheaper and way more efficient and more flexible. So I'm going to be telling you in this video how you can stop overpaying, and I'm going to help you once and for all understand deep in the money LEAP options and how to buy deep in the money contracts that replace your shares and make you some bicep over tricep money so you don't have to pay full price again. LEAPs, they don't just let you stay long-term in your favorite stocks while keeping your cash available for income strategies. They also help you with hedging. They help you get a proper exposure into a stock with a very cheap price, and they're also very, very flexible. It's a smarter, cleaner, and way better way to get long-term portfolio exposure into the stocks that you want for a fraction of the price. All you need to do is buy a deep in the money option that has a strike price that's deep in the money. And we'll be talking about that. I'm going to be showing you a live example in this video. It's going to have long exposure. And we're going to be looking at some strong stock opportunities that I am buying LEAP options today, right now, with some live examples. So the combination that I'm going to be giving you is going to show you how to have very strong performance for a fraction of the cost. So let me educate you, get a paper and pen out, and let's get right into this video. A LEAP is like renting the stock long-term instead of buying it. You get almost all the benefits of owning it, but without paying full price up front. It's literally a long-term ticket that lets you practice in the stock's move for a very small fraction of the cost. Same ride, lower price. Really good stuff, right? Now, these are the traits that define a LEAP option. First of all, it's long-term expiration. So it's going to be a 1 year or more until expiry. It's going to be a call option. And unlike short-dated options, a LEAP call option is going to have very slow time decay. When I go over the example, you will see time decay is very little. That's amazing stuff, right? Most time decay actually happens in the last 1 or 2 months, not up front. So LEAP option is very beneficial for time decay. Deep in the money LEAPs, they typically have about a delta of 70 or higher, right? That's my sweet spot. I like 70, but I'll show you some examples that might be higher in delta. And these are the best because they move almost dollar for dollar with the stock. So I'll show you an example live from today in just a couple of minutes. And this example will show you a deep in the money LEAP option. The reason why I go for deep in the money is because LEAPs have very similar exposure and behavior to owning stocks. That's why you can replace stocks. You don't have to own 100 shares of a stock, which is capital intensive, if you can just own a LEAP option instead. It's way less capital intensive, and that's me looking out for your pocket. Another thing is that it has lower capital requirements. So a deep in the money LEAP option might only cost you about 30%. Or in other words, it's going to be a discount of 70% less capital than buying 100 shares. So not only that, it also has defined risk. So you can't lose more money than what you pay for a LEAP option since it's just a call option that expires far into the future. With a LEAP option, your risk is limited to what you paid. You cannot lose a single penny more than what you paid. So that's really important. It also has a pretty low dollar amount of risk. Now it's not immune to market risk, but it has much lower dollar risk, which is very important, right? Again, we're looking for a strategy that replaces stock at a cheaper cost. So if you're looking to get leverage, whether you have a small portfolio, whether you have a big portfolio, either way, LEAPs are a really good part of capital to have in your portfolio. Because for me, this is exactly the strategy that I personally use to go from 100K to 700K. It's been a big proponent for me. And that's because when you're right on a stock, you want to use a LEAP option because it's less capital and you get a lot of upside. So if you're right about a stock's direction, LEAP option is literally one of the most powerful strategies that you can use without getting into the high risk category. Some of the higher risk categories of option trading are like buying out of the money call options and really betting that something will happen super fast. No. A LEAP option is a long-term, deep option. So you already have like pretty much instant exposure into the stock going up. A deep in the money LEAP behaves like stock because they have similar qualities. It has high delta, it has low extrinsic value, which means like time doesn't really matter that much. It has high intrinsic value, so it's already in the money. So it has the right indicators, it has the right components to behave like a stock, and it's long-term in its time horizon. I discussed this, by the way, in great detail in my community in the link in the description. So if you want to learn more about LEAP options and see which LEAP options I'm buying live, then you can check out the first link in the description. But I'm going to try to give you all the basics here for free so you understand what LEAP options are and how to replace your stocks. So let's now move on to why I use LEAP options and more specific details about them. Use LEAPs to grow your portfolio and make bets on bullish stocks. Why not benefit with lower upfront capital requirements? Like, look, because LEAPs have built-in leverage, and in 1 year, your risk management is way better off. Your ROI is also greater per dollar invested. And a deep in the money LEAP might only cost 70 to 85% less than buying 100 shares. So this strategy is good to use on Nvidia, on Tesla, on Meta, on SoFi, on Palantir, and all the other stocks that I have in my portfolio. I have a lot of these stocks. LEAPs are good on all of them, especially if you want to make your capital more efficient. Most people can't scale because they simply just can't pay attention enough to learn a powerful strategy. I'm going to be revealing the game-changing info for you. So try this. Next time that you buy 100 shares of stock, instead, just buy one call option with at least 70 delta that is 1 year to expiry. If your goal is to make money, if a stock rises, just replace it with a deep in the money call option, and that call option will basically give you the same benefit as a stock, but now you can have more positions in your portfolio, more diversifying. And diversification is obviously super important. I remember when I first was scaling my portfolio massively, and I first learned about LEAPs and how to actually use them and how to take advantage of them, it completely changed my game. I was dumping so much money into random stocks, trying to, ride momentum. One of them was Tesla, okay, which I made it big on Tesla. But just because I was right on Tesla didn't make my portfolio go from $100,000 to $700,000 in 2021. What actually did was me dumping just $5,000 into Tesla and that position becoming $20,000 in a matter of weeks. When I had seen those results, I was like, why? Why was I buying stock? A stock can't turn 5K into, a lot more multiples. It's not going to happen. And it's definitely not going to happen in a matter of weeks. So the type of return that I saw from a LEAP option was only because of leverage. In 2021, I used leverage to get a return that took my portfolio literally from 100 to 700. And without LEAPs, I would not be able to do that. Without buying options, I would not be able to do that. There is a place and time to buy options and to do it profitably. I'm going to be showing you an example, obviously, but I just wanted to point out, but this story is something that is replicatable by even a beginner. It's just a matter of picking the right stock and entering into the right position. This was back in 2021. And when I saw what I finally gained, made me really realize that wealth is a lot closer than we think. It's not overnight. It's not, in just in 1 week or 1 month. Obviously, you can't dump, 5K. I turned my LEAP option on Tesla went from $5,000 to it was like $19,700 or $800. I don't remember because it was back in 2021, but it was this crazy massive return between 19 to 20K. And obviously, I did not dump my entire portfolio there. Right? Had I dumped, I just wouldn't have the balls. I just literally, my balls are not big enough to put in 50K at a time. I wouldn't be able to. And that's because that wouldn't be proper risk management, position sizing. And at that time, I was still learning, to me, how risky I could be. How much was I willing to invest? For me, 5K was still a pretty big investment, but it ended up paying off huge. So if you want to grow your wealth quicker and be part of a bull market, which we're in a bull market, baby. We're in a very good market. I know sometimes the market goes down and we all feel down because it goes down a couple percentage points, but we're on one huge bull market since 2008. The market just continues to go up with some pullbacks. That's fine. Pullbacks are healthy. So we're not here hoping that the market's going to do good. It's basically the rule. The market just does good. So because the market just does good, buy LEAP options on high quality stocks and position yourself for massive gains by choosing the right stocks, the right LEAP option, the right expiration date, the right strike. Yeah, I know it made it sound all easy, but I'm going to show you some examples that you can probably print money from. Not for sure, right? Because in the market, you never know. If the market pulls back, you can lose some money. But if you have several LEAP options and we continue to be in a bullish market where the stocks that I'm going to show you, I believe are going to keep going up. It's like steroids for your portfolio. It's like getting massive gains while putting up very little amounts of capital and taking on less dollar risk and literally diversifying yourself better. So you're taking on smart risk. And this is basically how you scale your portfolio. So let's not waste any more time. Now you understand everything. Let's go into my live examples. All right, guys, we're going to go over some examples, but real quick, the first example I'm going to be showing you is Meta. And you can see on my screen right now that on November 17th, I ended up recommending the 600 leap call option on Meta for September 2026. This was a deep in the money leap. It was actually not super deep in the money, but that was actually a huge benefit because it was very low cost. And this trade that I recommended in the Options Retirement Academy ended up making so much money in profits. And I am super happy that this was a recommendation that I made for the members, and they have already seen a massive return from this specific position. We also opened up some other positions here. I open up trades regularly on Mondays, and that's the main thing that I'm doing in my coaching sessions is I'm putting out trades. If you're interested in getting trades and seeing what I'm trading, as well as leap plays, covered calls, selling puts, and much more, I am trading every Monday. You can look at that. The first link in the description. We also have another coach here that's putting out trades as well. So that's something that you should look into. All right, guys, let's jump into the portfolio. It's currently sitting at $103,000, which is pretty good, actually, considering the market's been volatile. I'm up in the 100K portfolio here, so things are going really well. Now, the first trade that I want to show you is going to be Meta. Meta has run up. And again, I ended up purchasing the Meta Leap option, recommending that to the community on the 17th of November. So it was trading for around $600 per share. And obviously with Meta being at, $672 right now, that is about a $65 increase. And that has literally been, I don't even know, like just the most massive return ever, like literally crazy return. Crazy. Like, I don't even know what else to say. I just want to show you this trade one more time. I still think there's more money to be made. Okay, I still think there's more money to be made. And again, the whole point of a leap option is that the cost is just way lower. Like, if we look at the side-by-side cost, buying Meta, right, 100 shares, when I recommended it was $60,000. Now it's still $67,000. It's a very high amount. Now, if I go for the September 2026 expiry date, right, and I show you what the 600 call is, it's $139. I mean, when I purchased it, it was in the $60 premium range. So that's literally $6,000. Now it's trading for, well, it's going to be around $139. So it's going to trade for more right now, and that's because the stock went up and this option became a lot more valuable. But again, the side-by-side comparison of cost is buying 100 shares is going to cost you, 67 grand. Okay, not everyone has that just laying around, right? And the leap option here is going for $13,900. So massive reduction in cost. And if we look at the delta, okay, the delta of this is 0.72. So very high delta. And that just means that if Meta does the same thing, right? Like what I said, it went up, $70 from when I recommended it. Essentially went up 70, a little bit less, $60. If it were to do that again, right, what would happen? Well, if Meta went up $60 again, it would be $730. I mean, that could happen again in 30 days. I mean, anything is possible with the bullish stock like Meta in a bull run. Okay, I know the market's been choppy, but Meta has been very predictable after the crash that it had. That to me was very obvious that it would recover. That's why I put out that trade in the Option Retirement Academy private Discord, because I was very confident. I was extremely confident that we're going to see good results. When I'm looking at buying a leap option, I'm still looking at the 600. The delta is right in the range that I like. Volume is a little low. It's not too low, but it's a little low. Open interest is very good though. It's over 1,000. That's great. So here, if you end up buying this, it's going to cost you $13,900, and essentially your break even is going to be in the 730 range. However, you do not, I'm going to repeat this, you do not need to hold until expiration. You really don't. You don't have to hold a leap until expiry. In fact, usually I take profit and I cut the position when I'm reaching the halfway mark. So when I'm 6 months into a 1-year option, I'm looking at taking profit, because in the last 3 months is when time decay and theta really starts to eat into the option. So
I don't want the decay to really kick in. Right now, this $600 strike, it's $72 in the money. So $72 of this premium is intrinsic value where the option's already in the money, right, by $72. The rest of the value, which is literally another like almost 70 bucks, it's like 68 or 69, just doing the math on the spot. Basically, the other 50% of the option's value is time value. Okay, you're going to lose that time value if the stock stays the same and it doesn't move anywhere. So if it doesn't move anywhere and expiry comes September 18, 2026, that the rest of the half of this option is going to leave. It's going to decay, right? So you really want to cut the position before the last 3 months, because the last 3 months is where the time decay really happens. So right now we have really good intrinsic value, and we don't want the extrinsic value, which is the time value, to start to kick in and really decay this option, because right now we're deep in the money. And deep in the money matters because we have a lot of control of the stock, right? So we have a 72 delta, which means effectively this leap option is giving us 72 effective shares. That's how you should think about it. You should think of it as replacing stock, and this leap option functions as a replacement of stock. So how much are we replacing? Well, we're replacing 72 shares. How much are we paying? Well, we're paying a small fraction of what we would pay for Meta. Okay, so on this trade, you don't really need to look at the break even because you're not going to be holding this option until expiration. What my goal and my plan is, and I've already made so much money, I'm already telling my members like, hey, we can even take profit at this point. So if you haven't made this trade, you missed out. You really missed out on this trade. This was a return that has, in and of itself, just this one trade, paid multiple times for the community. But that's besides the point. I still think that Meta can gain more value. And my plan is that when Meta hits 700 to 750, in that range, right? I don't know when that's going to happen. I don't know how soon it's going to happen, but that's my goal. And when that happens in, say, January, February, I'm going to reevaluate this option and see if I want to take profit and close out this option. So this break even right here that we're looking at really doesn't matter a whole lot, because as we go up, this is just the end chart. This is at expiration at the end, right? So Meta will move up by 10 bucks, which is like nothing, right? That's literally 1%, okay? But the option will move up by 7 bucks, and $7 is pretty high because you're only paying 139. So 7 is pretty much that's like a 5% return. So if Meta were to move up by like 1% here, roughly, give or take, right? I'm just doing ballpark math. Then the sleep option is going to move up by about 5%. So you can see how lucrative this really is, that if Meta were to go up, that this premium is going to rise very significantly, very quickly. All right, now I want to show you kind of how the math is going to work out. These are a couple old examples. I'm just going to do a new example right now for Meta as of we're like almost in mid-December, on December 6th. All right, so this is some of the old math that I did. I just want to show you some really, really simple math and break things down, okay? This option right here, that's 600 strike price, $139. Literally, here's what's going to happen, okay? We have a 600 strike price, right? I'm going to write here strike. Let me zoom in here a little bit. We're going to zoom in like that. So that's our strike price, right? And we're getting paid 100, or we have to pay actually, since we're buying option, $139, okay? So that is the premium, okay? Now, take a look at it, 72 delta, okay? So if the stock goes up by $10, okay, all you have to do is take 10 multiplied by the delta of, it's 0.72, okay? So this is our gain for $10, right? So this is our gain. I'll just write gain here, not to confuse anyone. So this is our gain, right? So check it out. This is really, really cool, because this is our option, right? And let's just compare it to the stock. So Meta's at 672, right? 672. And if it goes up $10, well, that goes to 682. Well, this is such a small gain, right, on the stock. Okay, this is a 1.4% gain. Not that much, right? Guess how much this is right here. Again, I'm doing the math for you. Just so you understand. So I'm going to make this a percentage, and I really just need to subtract this by 1 so you can understand. So it's 1.49%. So this is old price. This is new price of Meta, right? This is the stock going up by 10 bucks, right? And this is the gain percent. So that's how much you gain as a percent. Now let's see how much of an advantage it is to be in a leap option. How much money do you actually make with a leap option? How much better is it? We'll check it out. So we're going to take this $7.2 of gain divided by the premium. And then, yeah, basically exactly as I said, it's about 5%. So this is our gain percent now, right? This is the gain percent. This is our dollar gain. Okay, this is our gain percent. So how much better is it? Well, here, the leverage we're getting, okay, is going to be 348%. So it's 348% better in terms of upside. Now, keep in mind, if the option pulls down, then of course you are going to lose money because a leap option is a bullish strategy. So when the market falls down, you're going to lose money. But of course, you lose money on basically almost all strategies when the stock market pulls down, unless you're buying put options, you're betting on the stock market pulling down. I mean, it's just a given that if it pulls down, you will lose some money. So I just want to point that out, that there is leverage here, but it's pretty smart leverage. I'm going to call it smart leverage, where you're paying a small fraction of the price to own essentially the same amount of shares, or you're replacing shares with leap options. And the delta is really going to help explain how much of those shares you are replacing. That's where we got the 7.2 from, is that when the stock moves up $10, your leap option moves up by $10, but multiplied by the delta. So effectively, it's a $7.20 gain versus here, which is a $10 gain. And that's why this strategy is called a stock replacement strategy. This is one of the best strategies that I'm teaching in the Retirement Academy because it's a great way to scale, okay? As you get a bigger portfolio, you want to lean more into the wheel strategy. You want to lean more into selling puts, covered calls, selling options. But to grow your wealth, to grow your portfolio, or just to have a higher risk, higher return strategy that I wouldn't even call high risk, it's just higher risk than the wheel, but I'll call it medium risk strategy, high return, is going to be using leap options. And that's why I'm always researching good stocks to buy and use leap options, because leap options is one of the best things that you can use to really leverage, smart leverage. So again, here, this is the total impact that you're getting in the math breakdown of buying a call option, a leap option, that's long-term in 1 year, on Meta versus the stock itself. And by the way, this is just like a $10 gain. If I were to switch this, and let's say that we're going to do like a $50 gain, right? Which is this is my end goal anyways, so I don't know why I showed you 10. Well, I showed you 10 to give you the foundation, but let's actually do 50. Okay, so this is my exit point. This is my goal, basically. If I can get a $50 gain, right, in the stock, so we're going to do 50. So we're just going to do this number plus 50, right? So if Meta goes up 7%, and we already know, like, there's sometimes in the stock market, 7% moves in a week, right? But I'm saying in the next 3 months, right? So I'm being very conservative. If Meta has the momentum and it goes up 7%, right? This is the effective gain that we're going to see on the option, right? This is not exact because obviously there's some theta. There's going to be a small amount of theta. It's not really big, but there's also gamma. Okay, let me explain to you real quick. I'm not going to go into deep details here because this is a beginner tutorial, and you don't need to know the huge deep details to be a successful trader. Okay, so if I'm scaring you or this looks hard, don't worry, you don't need to know everything here. I just want to explain real briefly. As an option goes up and it becomes more deep in the money, the delta goes up. Okay, we know that's true. We can see that even here. If we go up to 660 here, the delta is going to be less, right? Because it's further out of the money. It's not here, right? But if it was more deep in the money, right? So if there was an option that was at 550 and it's become deeper now, you can see it's worth more because it's a deeper in the money. There's a higher chance that it's going to expire and stay in the money, okay? So the more the stock goes up, the higher the delta will become, okay? So as the stock goes higher, this strike price that stays the same is going to be worth more because it's deeper in the money. Okay, that change in delta is measured by gamma. And gamma is very, very small. You can see it's super tiny, and that's why it doesn't really matter that much. So theta is really small, and gamma is really small. So these are fairly negligible, especially when there's not a huge move. But when there's a $50 move, well, it's going to be a little bit higher on the delta. The delta is going to change, and let's say that the delta is going to be, something a little higher, not that much higher. Maybe it's going to be 76, okay? So you can see here that the gain is actually going to increase even further, but we also have to take into account theta. The option is going to decay a little bit, And let's just see how much it would decay. It's basically decaying about $1 and, no, excuse me, this is actually $17 a day. So in like 3 months, it's probably going to lose, $17 times 10 is like 170. So in a month, it's losing about $500. So in 3 months, it's going to lose maybe $1,500. Okay, $1,500 from this total premium. We're obviously at $13,900. So if nothing at all happens, then this option is going to be worth, say, $12,400. So $12,400. Okay, so it's going to lose about $1,500 worth of premium. So if we were to take off 15 here, then the gain would be not 38, but it's going to be 20. Hold on a second. So 38 minus 15, yeah, 23. Okay, so it's going to be 23. So yes, time decay might actually kick in a lot. However, if the option goes up, the time decay could change. And if the option were to go up, the volatility will change. So to be honest, I don't think that it would be impacted by as much as 23. So let's just call it 27, right? Obviously, that's a really big factor is time. That's why I say do not hold the option until full expiration, because yes, it's gonna kick in a lot more than just $1,500. It's gonna kick in like well over $6,000, right? Well over half the option's value. So this is the gain for this gain. So this is basically my exit plan, right? My exit plan isn't exactly. I want to get this gain as fast as possible. I'm telling you, this is after 3 months. Of course, if we go back, just go back here to 38. If in 1 month, right? I said it's $500 a month. That basically this option is going down. So that's 38 minus 5. This is my exit point. This is my ideal exit point. This is where I want to kind of have a gain. So this is my exit strategy here for this leap option is within 1 month, I would like to see a gain on Meta. Obviously, this is not always going to be possible. It's very situational based. That's why getting experience under your belt is important. Having a coach in your corner just to show you and tell you kind of what trades to make and how that looks like and how to manage each trade is very important, because this is very situational. But this is basically my goal here. So yeah, if you want coaching, click the first link in the description. But let's get on with this video and talk more about some common mistakes that you can potentially be making.
I hope that live walkthrough leveled you up. Now let's talk about some of the risks a little bit more closely. You never want to hang on to leap option during the final 90 days, because that's when time decay really accelerates and starts to eat away at your contract value. So you want to get rid of your position once it starts to approach expiration. At that point, it's also pretty much a short dated call, and a short dated call is very speculative. It's not a strategy that I ever teach to my students at all. We focus mainly on option selling. And when it comes to leap options, we really want to make profit within that first 3 to 6 months, and that latter 3 to 6 months, and once it's approaching expiration, is more of that dangerous period where you don't really want to hold the option close to expiration, as a time decay just way too much. So if your leap feels stuck in the beginning stages, that's fine. But if it feels stuck in the later stages, you just want to cut that thing out or just take profit. Honestly, most of the time you'll take profit if it's a bullish stock. And because leaps are long-term tools to basically gain benefit from a stock, right? For example, like when Palantir went IPO, I was recommending it on my channel. It's, I got in at around $21 per share. I was buying some leap options, but I did make some mistakes, and I ended up taking profit too soon. And other times I ended up just holding up until expiration. And that was pretty good because Palantir was bullish, but then those options started to actually make a little bit less money because the time decay starts to really eat into the option. So if you want to understand how to actually trade leap options better, potentially make money from them, trade them more consistently, entry and exit tools, I have another video that you should check out right here on leap options, how to really master the strategy further.